welcome to this week's edition of Selfwealth Live after we took a week break because of me. Hi, Jason. How are you?
Hey, Rog. I'm good. Good to be back in the show to talk. Fair bit going on in the market, so I think it's a pretty interesting week to have a chat about the charts.
Yeah. I think, when I checked them this morning, I'll be honest with you, it was the first time I checked the markets since Friday, a week and a bit ago. I had a complete break from everything to do with communication, the markets, anything online other than maybe a bit of social stuff because I was in Fiji for the week. And have you been to Fiji before, Jace?
I have many times over the years, and such a good spot to get away with the family. And I went with my family as a youngster, and with my family with my youngsters in recent times. So yeah, a lot of I'm sure you had a great time.
It was fantastic, man. I went over there for a sister-in-law's wedding. So we had a destination wedding, and it was such a beautiful place. Port Denaroo, I think I probably said that wrong, right? But it's where a lot of the sort of popular resorts were there. But we stayed at the Hilton there, and it was just fantastic for kids. We had 5 crazy kids running around. So it wasn't really relaxed, but it was very relaxed. The people are amazing, so friendly. And I know this is not a plug for Fiji right now, but if you haven't been to Fiji, I highly recommend that. It's a great spot to go to. Absolutely beautiful place, mate. But I'm feeling refreshed and ready to go now. I did have a quick look at the markets, a bit of an up and down down and up situation happened over the last week and a bit. I did log into my share trading portfolio once to see I wasn't too far down. So I don't know about you, but maybe we'll talk about holiday trading after this. Maybe this is going to be a question for you later on, Jason, because I know not being able to log in. I was able to log in. I just chose not to. Probably not the best thing to do, right? Considering you got money on the line and who knows what can happen to the markets, right? I think I was just trusting of that. It was good. Welcome everybody online who's come and join us today. It's fantastic having you back. Good to be back once again. And Jace, look, mate, I'm going to pass it over to you for the disclaimer and whatnot, and then we can get cracking, hey?
Well, don't worry about being out of the loop for a couple of weeks. I've got you covered. Lots of stuff to go through today, so we'll get a full update in a moment. Before that, though, quick disclaimer that everything today is it's general commentary only. No personal advice is part of what we do. And let me just quickly put this slide up, and that just goes through all that. And the other important point is I'm not part of Selfwealth. I'm from Motion Trader. My details are at the top, licensing, etc. And Selfwealth is below that with its licensing details as well. So that sums up that. So back over to you, Rog.
Fantastic. Thanks, Jace. And if you didn't know and you're just sort of joining us for the first time, yes, Elizabeth, you're there. You can ask questions to Jason. That's the whole point. He is our expert here in this show. I'm here simply just to host the show from Selfwealth. So if you don't know what Selfwealth is, obviously Selfwealth is the broker, is an Australian ASX broker. CHESS-sponsored broker, and then you can also access US and Hong Kong shares as well through Selfwealth. And Jason runs a Motion Trader service at his website, motiontrader.com.au, where he has a bunch of education and systems around trading the ASX. Primarily the ASX market, right, Jace? So, of course, you can ask any questions you want. What we're going to do is we're going to analyze the ASX, the US and Hong Kong markets. Then we're going to open it up to general questions, and then we go through the tickers that you would like us to analyze. Just remembering that we want to specialize here with technical analysis on this program, right? And this show is all built around the premise of being able to analyze the charts, so see the charts. So we might not be the experts in being able to analyze, the fundamentals of a company, all right? What the profits and losses and the revenues and the earnings and all these other fantastic numbers that companies have to put out to the market, right? We are analyzing on the charts, right, and how the charts looked, because basically the charts show the story of these things anyway, right? So So that's what we're here to sort of explain and to help people with, along with systemized ways of doing things as well. All right. So having plans, having ways of getting in a trade and having ways of getting out of trade, because I think that's probably one of the biggest gaps in people's in people that don't know, or people maybe beginner traders, people even experienced traders. They'll just get they'll just get tips, stock tips, but they'll get in it, but they'll never know what to do, when it's going against them, right? Or even when it's going for them, if they stay in or stay out, right? So we're here to provide some great systems, hopefully. Is that right, Jason?
Yeah, I think that's a really important point you made, Rog, that it's systemizing. It's systemizing a process. And when you systemize something, you make it repeatable. And this is a struggle I think a lot of people have, in that they might have a win, but then they can't repeat it because they did a bit of this and a bit of that, and nothing can then be overlaid like a template. And that's what we do when we systemize. We template, and the old rinse and repeat, and you do it over and over again. And if you've got a good process over time, that should work in your favor. It doesn't guarantee success at every point, but nothing does. It's about having that process. It minimizes your downside, maximizes your upside. As I say, making it all repeatable. And that's what we talk about when we go through the type of process that I use. And what we're doing with looking at the charts today, it's more looking at the structure. We also look at the structure of the market. What structure is conducive to making money, and what structures are best avoided. So we will do all that as we go through the charts.
Yeah, exactly. And obviously, if you've been seen us, you've probably heard a lot of the stuff we've talked about over and over again, right? But it's good to hear things over and over again, because sometimes it slips, right? So it's great to confirm what you already know sometimes, right? So, all right, I'm going to start you off with a question of the day here, Jason. I looked at my portfolio once while I was away for a week, 7 days. In Fiji, enjoying myself in the sun. Now, what would it's probably not advisable to not look at your portfolio for a whole week, right? But what were you doing when you're on holidays with your portfolio? Were you checking every day as well and sticking to the system? What were you doing?
Oh, look, I tend to check in every day, and just because I'm interested to see what's happening, not because I'm worrying about, oh, look, something's moving up quickly, I've got to do something. It's just out of interest. But what you did, I think, is a great way to operate. It's a powerful, it's a power to you if you can step away without the need to be looking for reassurance about everything going right. If you've got a good process, you should be able to step away, because you can have things like stop losses in the market that can get you out of positions when they're not going your way, and letting profits run. I think one of the great things about not checking your portfolio all the time for a lot of people is that it helps them resist the urge to do something when they actually don't need to. So if you're looking all the time, you see your stock's up 5% today. Some people are going to think, oh, that looks pretty good, I might just lock that in. Whereas if they went away and they came back next month, they might find us up 30%. So not looking all the time can be good if you're inclined to then want to find things to do. So if you want to find things to do, you're better off stepping away and let the market just run its course, and exit positions when need be, but let profits run, which is a really important thing. So yeah, look, I like that, Rog.
Yeah, and I think one of the things that I did just before we left is I didn't see my portfolio, and I looked at looked if anything was close to my exit stops, and if they were, was going to put a stop loss there, but nothing was close, right? So failing an absolute crash, I just felt like nothing was going to happen. Going on feelings probably not the best way sometimes, right? But it was, in the end, nothing happened really. So it was kind of good. But I feel like if they were close to a stop loss exit, any of my holdings were close, I would have put a stop loss on anyway, knowing that if it had gone further against me, right? So nothing was close. So that's the way I worked it, like you said, right? You can put stop losses on in the Selfwealth platform. You can put stop losses on your system as well, if it's going against you, right? So all right, well, good. Glad to hear that I did the right thing according to you then, Jason, just stepping away and having a rest, right? Having a mental rest. It's always good. All right, let's go and have a look at the ASX market. And can you please update me on what's happened over the last week, please, Jace? Thanks.
Okay, so let's click over to our charts. And so first chart, that is not the ASX 200. That was the small ordinaries on the chart then, but we won't worry about that for now. We've got the ASX 200 to look at. And I think we've had some constructive price action since our last show a couple of weeks ago. Now, that some people might think that sounds a bit surprising for me to say it's constructive, because the market is lower than it was a couple of weeks ago, and there's been some volatility. But this is the type of price action that this was the possibility that we spoke about last time, a couple of weeks back. We spoke about the possibility of the market pulling back towards the moving averages. So I've got the 50-day and the 100-day moving averages on this chart. And the reason for that was that the market wasn't ready to move higher a couple of months ago when we had this false break, had this nice big trading range, broke higher, market couldn't sustain it. We had that sharp move lower in August. So the market wasn't ready to move higher a couple of months ago. And fast forward to now, and it seemed to me like nothing had really changed, and that there was the likelihood of that more consolidation coming in. And also we had the situation where we'd had a very strong rally off the panic lows from August. And when you get a strong rally, you often get an overbought situation. And those situations then need consolidation. And what was interesting was the ASX 200, it swung from being on the low side of the moving averages to being up above the moving averages. And when we get these extremes in price action, you often get that return move to the moving averages as the market then consolidates all that price movement. And I like that we're seeing this pause in the rally now. So my favoured view from here is that we still have several more weeks of consolidation ahead of us below the all-time high, which we saw in August. And I think if we do get more consolidation over the next several weeks, I think that could actually set up a platform for higher levels heading into the end of the year. So we've got to let the price action firm itself up a bit more. It's a little bit too far away at the moment to be looking for that move, but I think that's how this could play out if we do get that consolidation. Now, there are all sorts of ways this could play out. I think the most bullish scenario would be something where the price where we see sort of price action kind of like this, where it just tracks sideways for several weeks, maybe through the rest of September. And then from there, maybe we get the potential of a break higher. So that's one scenario that could play out, that we could look out for over the next few weeks. When we get that price movement along moving averages, it's often a sign of buying interest underpinning the price. And then once all the supply gets absorbed, that's when we can then see those breakouts higher. So that's one way this could go. Another possibility is that we get more of a zigzag type structure. So it could be something like maybe we see the market start to head up and then head down a bit, get a bit of a zigzag structure, and from there we start to see it work higher. So you get that classic zigzag shape to the price action. So as I say, there's all sorts of ways that this could play out, but there are a couple of the typical templates that we often see in markets, either sideways along the moving averages or the zigzag consolidation. And as I say, I think this could take us through the rest of September, and but then from there we could potentially then look for stronger price action going through October, November. Of course, these are just a couple of possible scenarios. I don't know what's going to happen. Something completely different could happen. Might not be bullish at all. But at this stage, I think the play is just stay with this incumbent trend. I think this incumbent trend is to the upside. And people might say, well, look, if we don't know what's going to happen, why bother going through possibilities? And I think the purpose of considering how the price action may play out, it's to give us a mental guide of what an ongoing consolidation could look like. And those scenarios I've outlined, they're classic templates we often see in markets. And I think if we understand some of the things to look for, I think that can then help us be better mentally prepared for some of the things that could play out. And where things stand now, I think it's it's a case of staying long the market. I think it's using wide trailing stops. And I'm also I'm on the lookout for good setups to get some more money into the market. And maybe over the next few weeks, if we get this price action that we've been speaking about, maybe we get those possibilities.
Yeah. And I mean, I found it interesting to come back to the chart and see just literally over the last couple of days, it has rebounded back hard off that 7,800, 7,900 level of interest. I think that's a key point, right?
Really interesting price action. So like I did my weekly strategy session on Friday, and so I recorded on Friday. It goes live on Saturday. So one of the things we're doing it on Friday is I missed the Friday's price action in the US, and it's usually the viewers from America who comment about that. They can't get their head around missing one of the days. And the point I make is a single bar on a chart rarely makes a difference to the overall structure. But they came in and they saw the Friday price action in the S&P 500, which was down 2 and a bit %, and there's quite a bit of a bearish reaction to that. But it was like it's one down day, and you see how the market's behaved since then. It had a sharp down day on Friday, and this captures the evening session. This is not just a day session. There's with futures and CFDs, some of them trade through the Friday night. So this got that sell-off. You can see the sell-off on this chart, but then the strong rebound off the moving averages. So it remains very much a corrective looking structure at this point. So I think, like, don't get carried away by 1 day or 2 days. There's a whole lot more to a market structure than just a couple of days, unless, of course, it's breaking the key level. But where things stand at the moment, this is just, at this stage, it's just pulling back to moving averages, which continue to be rising.
Yeah, no, that's good points. All right, fantastic. I'm just seeing a few comments as in, look, they missed our show last week. I just want to say, look, guys, it's fantastic hearing these comments because it makes us feel warm and fuzzy inside, obviously. But we missed it as well. It gives us a break sometimes here and there. So I hope you appreciate that. But we do love coming back and just talking about the markets in general and a technical point of view. So thank you for your lovely comments. Fantastic. All right, let's have a look at the US market, Jace.
Okay, so we'll go over S&P 500, and Roger, there's been a lot going on. Been a lot going on in the S&P 500. 2 sizable down days in the last week. So on Tuesday last week, there was a down day of about 2.5%, and then on Friday, this is what we were just speaking about. We had this other down day of a bit over 2% as well. And last week was actually the biggest weekly drop in the S&P 500 since March last year, which is, there's been some volatile periods. So that was something interesting, which I read earlier today, that last week's drop was the largest since last March. And the NASDAQ was actually the worst week since January 2022. The other big headline, which I saw last week, was NVIDIA. It was down 9% on one of those days. I think it was the Tuesday. NVIDIA was down 9%. So it lost, and this was an interesting stat, it lost $278 billion of market cap in one session. Now, that's the worst ever single day wipeout for a single stock. So these are all headlines which were appearing at the time. And now, if you're just reading the headlines, this all sounds really bad. We've got worst declines in a year or so, worst wipeouts in single stocks ever. It's but that's the thing with headlines. Headlines often sound bad. I think we always need to step back and assess the underlying price action rather than just taking the headline at face value. And so, starting with the S&P 500. as it stands, we have a strong rebound. So looking at the panic low from August, we've got a really strong rebound off that low point, and that's been followed by a pullback to the 50 and, well, actually somewhere in between the 50 and the 100-day moving averages. So this isn't bearish price action. In fact, I'd suggest that this V-shape decline and recovery is actually a sign of strong underlying buying interest. So when you get a market that sells down, gets below those moving averages, it does become vulnerable. So if a market then starts to just track sideways, not be able to muster a strong rebound, that's a potentially bearish sign. But that's not what we got. We didn't get a sideways muted bounce. We got a really powerful rally that erased pretty much all of those losses. So that's a sign of that strong underlying buying interest. And we also have the rising moving averages. So the 50 and the 100-day moving averages, they've been rising for close to a year now. They're still rising. Prices is generally above those moving averages. So nothing here suggests that the trend has changed. As I was saying earlier, one day or a couple of days, unless it's breaking a key level, usually doesn't change that structure. Focusing on this pullback that we've had. So it's come back to between the 50 and the 100-day moving averages. I think what we're seeing so far, what we've got so far, I think this is constructive price action. And what it does, it allows for consolidation of that big rally we saw off the lows last month. Now, one of the things we did a couple of weeks ago, which the viewers might remember, was we put an RSI on this chart. So let me just put that RSI on again. So RSI is a relative strength index. And the point that we were talking about a couple of weeks back was we had a situation where the NASDAQ was pretty close. It was just about at a new all-time high. But when you looked at the RSI, it was well below. It was a long way from confirming that upward move that we had in the price action. So what we spoke about a couple of weeks back, it was that seemed to be a sign that the pace of the advance wasn't sustainable. Market and this was a really strong period. But it seemed to be an unsustainable period, and that's what I thought this. You can't quite call it divergence because the S&P 500 didn't quite make a new high, but it was so close. For me, it was like an effective divergence. And so that was a sign that there was probably more consolidation in the making. And I think that's what we're seeing now. I think we're seeing a larger consolidation play out. And this could, like I was saying with the ASX 200, this could play out for several weeks. All sorts of ways this could go from here. But I think the most significant price action is, in the last couple of months is this strong rebound off the low. So we're at a stage where, at the point of maximum fear during August, when the market was its most vulnerable, there just wasn't an appetite to take prices lower. So for me, that's a sign that the path of least resistance is to the upside. So what I'm looking for now, like I went through at the ASX 200, I think it's consolidation, whether it be sideways along the moving average or we get a rebound and we get the zigzag pullback. I think it's all range-based trading for the time being. For me, that means it's a case of staying long stocks, using wide trailing stops to try and see off pullbacks and consolidations. And I think this current consolidation, I think it sets up buying opportunities. We need to wait for that price action to evolve, but I think that's where it leads us. So I'm interested in the stocks that pull back to their moving averages, consolidate around those moving averages, and then start to rally off them. They're the sort of situations I'll be looking for over the next few weeks as this price action continues to develop.
All right, fantastic. Thank you, Jason. Now, what about, I just had a look at the Hong Kong market. Doesn't look any different, really.
Well, look, not much to say here. There's just no immediate momentum in this chart. in either direction. So prices are just oscillating either side of the moving averages. Maybe there's a range forming between the previous high and the low from August. For me, there's just nothing here. It's best. I think it's a market that's best left alone. I've got this while we're here. I just clean this chart up a bit. I've got, you can see this. This was quite a good support resistance for a while. We've got a nice break from there in April. But then when the prices came back, it sort of like shot through to the downside in August. Then it's now gone to the other side. I don't think it's adding a lot of value. So let's just take that off the chart. Sometimes it helps to just clean up your charts so you don't just end up with a whole lot of clutter everywhere, particularly with the price still around that point. We'll see whether we can see some other patterns appear in the charts rather than focusing on a support resistance, which probably isn't doing that much anymore. Looking at quickly over to the Chinese market, this actually looks weaker than the Hang Seng. Prices are making new lows this week, and that happens to be below declining moving averages. So this remains, for me, vulnerable to the downside. So I think a market which is just best avoided for now.
Yeah, China looking pretty bearish there. All right. Okay, so let's move on. There's a couple of general ones here before we get on to some tickers. But if you haven't done so, please like and subscribe on our channel. Like the channel, or subscribe to the channel at least, and that way you get notifications when we go live. Don't forget about us, and also write some comments in there as well. That'd be nice. If you've got any questions, you can always shoot them through in the comments as well. We can read through them next week. All right, let's have a look at before the tickers. Let's have a look at the question here. An exit stop from Elizabeth here. Exit stop. Why is the percentage such a difference, 38% to question one? Does it mean that the price can drop as far as 55% at some point? I'm not sure if you know what that means, Jason.
Please read that question again, Raj.
Yeah, so one from Elizabeth here, TD Australia. Exit stop. Why is the percentage such a difference, 38% to question mark? Does it mean that the price can drop as far as 55% at some point? We maybe give us some clarity on that, Elizabeth, as in what. Yeah, maybe give us a bit more pointers as to what you're asking there. Just to me, it's not making it much sense. But yeah, if you want to write some more comments, and I'll go on to the next one as well. All right. So one from Talwyn here. Hoping you can give some more, can talk a little bit more about scaling out of bigger positions when the volatility is higher. Let's have a look at Doug, maybe, if we can, because he's referring to this, or they're referring to this one. Sorry. They are referring to this one. Only on overweight positions, higher double-digit gains. Do you use other technical indicators to scale out? So let's say you're up 200% on this, 300% on this. How would you scale out, Jason?
Well, this stock is up. So when this is a motion trader stock, the first signal would have been back around January 23. Thereabouts. So it's currently up. It's up over 300%. So, and this is a stock which I have myself in my own portfolio. I actually did scale out of this a few weeks ago. I scaled out of it just around $2.70, and that was during that period of volatility we had in the ASX. So after this big decline in the ASX, I was saying that, look, let's watch what the rebound looks like. And I said that maybe it's worth considering de-risking a portfolio in the event that we get a shallow rebound and then prices start to roll over again. That was one of the possibilities. We've got a V-shaped recovery, but we didn't know that at the time. At the time, this is what we're looking at. We're looking at a market that had gone from an all-time high to rapidly falling below its moving averages, and having over the first few days, it was a slow start to the rebound. So I suggested, look, maybe it's worth doing some de-risking. So that was a case of maybe selling stocks which were at a loss, which hadn't been performing, stocks which had hit exit stops, but you hadn't quite got round to selling any sort of rebound, maybe that was a chance to de-risk. And also scaling out of some big wins. If the size of their gains was making them just too big relative to the rest of your portfolio. So all different things you can do to de-risk. As it turns out, I probably would have been better off doing no de-risking because the markets gave us that V-shaped recovery. But we can only deal with what we know at the time, not what we know in hindsight. So one of the things I did, as well as cleaning up some stocks which weren't performing, 3 of my largest gains, I sold a third. So I wanted to, my process is very much about staying with the trend, letting profits run. But occasionally, and so this is only so there are 3 stocks in this round, and there's a stock I did this with several years ago. I think it's the 4th time I've trimmed large profits, and so in staying true to let profits run as best possible, I just shaved a third off. So the bulk of the position remains in place. I've just really just clipped the top off it. And I did that in case we were getting a sideways pattern which was going to break lower. So de-risking DougTech was one of those ones. Now I don't have a particular rule for it. There's often it's the case if a stock is when a stock goes up 300%, you go in like the many relatively small trades approach means that initially a stock doesn't make up a great portion of a portfolio, but once it goes up 300%, well, it becomes more meaningful. So if a stock's gotten to a point where its fluctuations have, for you, too much daily influence on the portfolio, it's okay to take some off the top. We spoke about this with Drone Shield on the day, I think it was the day or the day after it was actually peaked. We said, look, it's okay to scale out of a big profit. What that means to everyone is going to be different. Some people might want to sell half, some people might want to sell a quarter, some people might want to sell 2/3 and just let 1/3 run. Everyone's got to make their own decision what works for them and at what point they want to do it. For me, I'm really only looking at doing it at stocks which are up significantly, like 300% plus. Someone else might want to scale out at 100%. As I say, it's an individual thing. There's nothing wrong with scaling out. I think over time, when I do the back testing, the best results go to not scaling out at all, but we've got to deal with volatility and the emotional impact of volatility. So that's why scaling out can, if it helps you stick to your system better overall, I think scaling out can be a good thing.
Okay. All right. Fantastic. So essentially what you did with Doug was you took 1/3 of the position off. If my calculations are correct, as I just do them in my head here, like 1/3, you would have taken away so your gain now would be about 200%, right? You would have taken away enough to cover your initial investment. Is that right? Just to cover your initial investment.
Oh, I imagine, significantly so, yeah. Although that wasn't the, like, I often hear people say, look, once a profit has covered the initial investment, might only be, the stock might only have to be up 20 or 30% or something. I'll sell half and have a free trade. I don't like that approach because I think you're watering down your best stocks really early. I think you want to maximize your gain from your best stocks, not be taking profits or scaling out at an early stage. But once something's up 300%, it does become a larger portion of the portfolio. If you've got a 10-stock portfolio, if a stock goes up 300%, it might make up 30 or 40% of your portfolio. So it makes sense to take some off the top. I've got a lot more stocks in my portfolio, so any individual stock doesn't have that greater pull, but nonetheless, it still makes up a greater portion. So it's volatility management is probably another way to look at it.
Yeah, all right. Yeah, but I like the fact that I brought that up, though, makes it clear to the viewers that you're not just taking away your original investment like a lot of people would potentially look at doing and doing it too early, right? So, but it's good that you sort of.
Chose a third. I could have chosen, I could have gone with a quarter or 20% or a quarter, or it's a third for me is meaningful, but it's not. It's not undoing the bulk of the trade. The bulk of the trade stays on. It's just skimming off the top,
Yeah.
and it's skimming off enough so that in the event that the market went into a larger decline, that it was going to reduce the volatility within the portfolio when a stock which has gone up 300% potentially comes back, like its trailing stock might have been 30% away. And if you get three stocks coming back 30%, which are up significantly, that creates more portfolio volatility. So that's all I was aiming to do by just shaving a bit off the top. It's staying with that underlying trend, but it was just a precaution in case we went into a larger period of downward price action, which still could eventuate. Nothing saying it can't happen. I just think the risk of that now is a lot less than it was, say, 3 weeks ago.
Yeah, all right. Just quickly, do you do this for every stock that hits a 300% gain at the moment, or is it just more around the time that you thought?
No, it was all to do with the overall market situation, not the individual stocks. Usually a stock will... my best performing stocks, a couple have gone up over 500%, but 200 to 300%, you'd probably find most of them will I'll just let run their course. They'll peak and they'll come back and they'll hit their trailing stops. So this was very much a precaution to a market-wide situation, not a factor with an individual stock.
That's fantastic, and if you're following us week on week, you know exactly what we're talking about, right? So it's great to have this insight and knowledge in the way you think, Jason. Really is. So all right, well let's.
I want to downplay the power of staying with the trend. I think this is why 2/3 of the position is still in place. I don't want to get too clever and say I think this is running up, I'm going to take my profits now, because some of these stocks, there's nothing to say this stock can't double again, and it's like, I think taking profits for arbitrary reasons I don't think it's the optimal game. I think the optimal game is letting as much as your profit run as you can, whilst being able to manage your volatility and manage your emotional side and keeping everything on track. Let your profits run is such an important principle.
Fantastic. All right, Jason, let's have a look at a GQG for our first ticker for the day.
So this was a motion trader stock. I think it may have hit its stop loss just recently. It's back. It's below the moving averages. The moving averages appear to be starting to roll over a bit. Look, once the stock's below the moving averages, a degree of vulnerability comes in. So how's it behave from here? Like we could get a V-shaped recovery. It could be back up towards 290 in the near term, particularly if the ASX does stabilise around current levels, builds a platform, and then tries to break higher later in the year. We could see GQG do the same thing. What I'd be looking out for if I had this in my portfolio would be price action like this, where we just get this sideways movement. It doesn't get that strong rebound, and then whilst that happens, then you get that allows the moving averages to start turning lower like that, and then that opens a potential that you do then get the sharp decline. This isn't a forecast for what will happen, because I don't know, but this is what I'm looking out for. This is what I'd look for if it was in my portfolio and I was going, look, am I going to hold this? Am I going to give it a little bit longer? if I started seeing this sort of sideways structure, that's when I start getting worried that it does become vulnerable to that larger hit. But that hasn't happened yet. It could still recover from here. I think probably this low from early in the month is now key. A break below that low from at around, where is around 242. I think a break below there, then we start getting a series of lower lows, and you start to say, look, the trend or the technical situation really then starts to deteriorate. I certainly don't want to be a buyer here. I'd probably be exiting this stock, but if I was still holding it and I wasn't sure, I'd be watching the recent low and watching for that sideways price action as a warning.
All right. LTP.
Nice strong uptrend. It is getting stretched from the moving averages though. So this is one. And look at this classic little consolidation back into the moving averages. Like, I love it when we get these sideways compressions back into the moving averages. You can see there's such range bound periods. So price runs hard, gets stretched. You get the sideways movement back into the moving average. So this is your classic buy the dip. This is the sort of dip I'm interested in considering, where prices run hard, gone sideways, come back into the averages. Or if you don't buy the dip, you buy the breakout from that structure. So it's great when you know the sort of structure to look for, which can lead to, I think lead to a situation where the odds are in your favour, or at least you can manage the risk on an asymmetric basis. So, say 1 unit of risk for 3 units of upside potential. That sort of asymmetric setup, which I like to look for. Coming back to where we are now, well, look, where this price is now, it kind of like, I wonder whether it's not dissimilar to where it was in June, in that it did get quite stretched from the averages, and that at some point, the averages are a bit like gravity. At some point, the price will pull back to the averages. So whether that's whether that's like a zigzag pullback to the averages, or whether it's more like what we've seen previously, that's sideways, we don't know. Nothing's to say it can't shoot higher and make another high before it comes back to the averages. But at some point, it will come back to the averages as long as it continues to trade on the exchange. So I'd be letting this one run if this was in my portfolio, but I wouldn't be buying it at this point. I'd like to wait for the next consolidation, see what it looks like, and consider it from there. But yeah, definitely a let profits run situation.
Okay. What about CAT?
So I've got some of this in my own portfolio. Where is it? This has been trending nicely. It's a motion trader stock. Where would the signal have been? Signal could have been around November. Yeah, I think that's probably where the signal was. And there's that pattern again we just spoke about. So, like, I point these out when I see them because they're good to be aware of. So you can just look for them yourself, and you can see that. So below the moving average to above, market got stretched, came in, we got that sideways consolidation into the averages, and then that same strategy, buy on the pullback to the averages with a close stop, relatively close stop, or buy the breakout. Either way works, and you get that asymmetric upside. If this was in my portfolio, and it is, I'm continuing to hold it because the trend's up. There's nothing here that suggests there's a change in trend. There is probably going to be some resistance up around these previous highs, but that's okay. I wouldn't take profit just because there's overhead resistance. Maybe it causes the stock to pause, but I'm happy to let a profit run into that. It's periodically coming back to the moving averages, healthy uptrend. The question, wonder whether you'd so would you buy it at current levels? Probably not. I'd be looking at these resistance points and been talking, like, then we look back, what's the ASX doing? And we talked about the potential for the ASX to consolidate. I'd probably just want to watch it for for a little bit here. Like maybe we get another one of these sideways patterns where, you know, not dissimilar to what we saw around May or even before that, earlier in the year, where it does go sideways into the moving averages and below resistance, and then from there breaks higher. So maybe for me, the play would be, if I didn't have it and I was interested in it, maybe I'd look to buy a potential dip to maybe $1.90, have a stop loss below the 100-day moving average, maybe back at 177 or something like that. So relatively small risk. Or alternatively, if and it's all an if, because we don't know, do we? We don't know what the price action is going to be. But if we did get that sideways period, it could also be a case of buying a breakout. So maybe it's buying a break above the August high if we get a little bit more sideways in the interim. But interesting stock. Trend remains up, holding, and that's a strategy for potentially getting some on board.
All right. PXA, please.
So this is a motion trade. I'm pretty sure it's a motion trader stock, unless it triggered a stop loss in August. I know it's certainly been in the portfolio. This is an interesting. It's an interesting pattern. I'm wondering whether we've got this series of higher lows, and we've got higher highs. They're building blocks of an uptrend. The moving average is pretty messy at the moment in that the prices, it's whipping, it's generally been above the moving averages, but it has been pulling back beneath the moving averages and then rallying again back beneath the moving averages. So it doesn't have the strength to it that some of these recovery plays have, where they get above the averages and they consolidate, like we saw on CAT, where it just continues to push up when it comes back to the averages. I wouldn't buy it at this point. If I wasn't in this, I wouldn't buy it because it is sort of teetering to the lower side of these moving averages. So, you know, there's always that potential that it starts to roll over and break that series of higher lows. That said, this could also be like a wedging type of, how would we draw this? It's not a neat pattern to draw in, but you know, this isn't really a valid lower line, but it just gives us something to visualize. We've had the strong rally, and then we've had this sidewaysy type, downward sloping sideways compression, which we could well get price action like that out of. That would be entirely feasible. So if I had it, I'd probably continue to hold it. I'd maybe use the August low as a reference point. Breaks the August low, maybe it's time to then get out, because we start to get declining price below moving averages, which are rolling over. But there is a possibility that it can hold in here, stabilize, and push out of this pattern. So it's one to watch, and it does have that upside potential to it, and we can manage risk around it. It's nice clear levels around these previous lows. Below there, it's like time to step back and go, look, it's not happening now, but it could play out from where it currently is.
Okay. All right.
And everything we say is could. Like, some people will get frustrated and say, oh, well, you've said it could go up and could go down. And yeah, I've said exactly that. But it's asymmetric in how we play it. If it goes down, we can have a stop loss where we lose relatively little. But if it goes up, we have a strategy where we could make a multiple of what we might lose. So it's not about predicting what is going to happen. It's looking for the possibility of what could happen, what's reasonable to expect could happen, and going, look, can we build a risk management and a risk management strategy around that? And do we have the upside potential to justify it? That's what we're doing. We're not looking for crystal balls and saying, this is going to happen. There's no certainty with any of this. It's about using good principles and process and applying it consistently. And that's how we can do well over time.
Yeah, of course. And just to your point there, Jason, just remember we're only giving general advice. So it's nothing. You do your own due diligence on your stock. You choose take your own responsibility for what you do. Obviously, we're just here to give some guidance on how we look at the markets, right? From a price action point of view and the chart. So, all right, let's have a look at CPU. Computer share. The ones that come up a lot of paperwork for our.
That was them. Yeah, look, the trend is up. Trend is up. It looks very much like the ASX 200, and it's got that V-shape decline and rally, and we've also got this sideways compression going on above the moving averages. So this is a like when we see this, it's kind of a variant of what we've spoken about earlier, where price rallies and then you get the sideways move while the moving averages catch up. I'd be happy holding it if I was thinking of buying it for some reason. It's look, trend's up, and it could continue going up for who knows however long. I'm considering saying, look, I'd consider buying it now and put a stop loss below the 100-day moving average, because I do like that little sideways pattern. But then I'm thinking about what the ASX 200 is doing. I'll probably incline just to watch it for another week or two, see whether it gets a little bit more sideways motion to it while these moving averages keep coming up. But I'd be looking at it from the buy side, not the sell side. If I owned it, I'd be letting it run. If I was thinking of buying it, maybe as this moving average comes up, buy into the dip or buy the breakout to a new high.
All right. What about ORI?
Yeah, interesting to see how this one's been progressing. So I was speaking about this a while ago, in that it's start with the weekly with this, because it sets the scene for it. So it's this goes all the way back. This is 2007. So this has been a stock which hasn't been much fun for a long time. There's been periodic periods of excitement, but much of the time it's just been a grind lower. But there's a big support. You can see this big support that comes in around 1170. So we had it looked like we had like a bit of a basing structure in place, and price broke above this overhead resistance around $16.90 earlier in the year. So we've got a big support, we've got an initial rally, we've got a consolidation, we've got a breakout. And now let's come back over to the daily. And let's extend this across a little bit. So we've got support coming in just beneath the market. So we've had the breakout. So this looks to be a consolidation of the most recent rally. So structure looks good. We've got rising moving averages. They are going sideways at the moment, but this is during a consolidation. So it's not unusual for a stock to just get to a point where it oscillates either side of the averages. I like that it's finding support just above the previous breakout point. So it looks like there's buying interest underpinning it. If I had this in my portfolio, I'd be happy keeping it. If I didn't have it, and I wanted a large stock like Orica, I'd consider buying it. It could probably be bought at current levels. If somebody wanted to buy at current levels, they probably could. Stop loss wise, then you're looking at back below that previous resistance, which is now support. You're probably looking at 10%, maybe even less, 8%, 8 to 10% of downside risk perhaps, and you consider the upside, and it's like, yeah, it's certainly 3-to-1 upside potential. So it's an asymmetric setup for Orica. Alternate would be waiting for it to break above maybe breaking above the August high, so buying into a bit of momentum. So several ways could be done, but I think I'd be looking at this from from the aspect of buying it. I think there's potential here.
Okay, let's have a look at RAC, please.
Look, I don't really have a strong feel for this one. We initially had some upward momentum going, and you can see, like we've spoken about this previously, so I've had an overhead resistance there. It broke above the resistance, and then it just fell back. So this line doesn't actually do much anymore. It's you can see not every, like, it is finding some resistance there now, but you look at this period through July, it didn't really do much. So let's just take that off. I don't think that does much for us now. So what I'm thinking, I'm wondering whether this is like a lasting high in June, and it's currently, like, it's had an initial move down. It's got a bit of a choppy sort of, like, there's strong momentum to the downside, and then the price action since then has been choppy and overlapped and lacking momentum. So I wonder whether the next move could be to the downside, and we could end up with something which starts breaking down. That may not happen, but that would be my concern. So it's not a stock I'd want to buy at the moment. If I had it in my portfolio, I could give it a bit longer, particularly if I was in at a good level. I'd be happy to give it a bit longer. This August low is probably a key point. Below the August low, the whole thing starts to, I think, come apart, and I'd probably want to be out of it. A point to buy it, I'm probably not looking at a buying point at the moment, just while it looks a bit messy in here. I'd need to observe the price action some more. It could evolve into something which we could play from the upside, but at the moment, I'd probably be a bit careful with this one.
Okay, all right. What about the next one? We've got EZZ.
Yeah, great uptrend. Very much for me, this would be a case of letting profits run. It's a motion trader stock. Initial signal probably would have been back here in April. It's had a lovely run, and this is why we use wide trailing stops. Like, you look at this pullback to the moving averages, like, it's a 35% pullback, but it's only come back to the 50-day moving average. So I hear a lot of people tell me, oh, look, I use a 20% trailing stop. And that's all well and good. And a 20% trailing stop, that's an effective way to manage risk. And it does work. I do the back testing on it. The 20% trailing stop, it's a solid strategy. The weakness with using a fixed percentage is that a stock can get stretched above its moving averages, pull back to the 50-day, and then rally again, but it's 34%. So if you're just working on that fixed 20%, you're going to have trouble with some of these stocks which have a tendency to have a bit more volatility to them. That's why I'm using the ATR-based trailing stop. So ATR is average true range, so it's a volatility-based stop. So the wider the wider these daily trading ranges, the wider the trailing stop, the more room you give it to move around, because you need to, because it's whipping around more. So look, just different things to consider when you're, like, working out your exit strategy. But coming back to this stock, uptrends in place, I'd be letting it run. I wouldn't be buying at the moment because it is stretched above the moving averages. I would have said the same thing in September, start of September. I would have said, we could be looking at it here. I'd be saying, oh, look, I think it's a bit stretched above the moving average. I wouldn't be buying it here, and it's gone higher. So it's not to say it can't go higher. Just, I think the risk reward, the asymmetricness of the situation starts to tilt away from you when you're buying something which is stretched above the moving averages. I'd rather buy it when it's closer to the averages and starting to break out. They're the times where I think the setup plays in your favour better. At the moment, though, I'm watching from the sidelines for the next consolidation. Maybe that presents a buying opportunity. But as I say, at the moment, it's a let profits run situation. If someone already had it.
All
And
right.
of course, scaling out. There's always that scaling out strategy. Like if someone's in from near the initial breakout, oh look, it's 260%. I probably wouldn't be scaling out at this point in this stock. But it's we talk about it sometimes. We talked about it earlier today. It's okay to do that if you've got a big profit. It's when you're below 100% and people start scaling out. It's like, well, come on, are you really maximising your winning stocks as effectively as you can? Once they start getting up over 200, for me, it's like, well, for me, it's probably 300 for me to say, look, I might just trim it. But yeah, it's something for everyone to consider.
Mm-hmm. What about DUR?
Well, this was a stock I had a while ago and I got stopped out of. And it was a motion traded stock too. So moving averages crossed, initial breakouts, they were back in August 2022. Rode a really nice trend, went through an initial pullback. Trailing stop, where was it? Trailing stop, I think, triggered somewhere around here in March. So this is around where I got out. So I got out and left the motion trader portfolio. There was a bit more weakness, but then it's since stabilized and started to push higher again. Looks like it's starting to get some momentum back. So moving averages have crossed back to positive territory. This is close to triggering a new buy signal. Like where do you put our resistance? I'm just playing with the lines at the moment. I could probably use a horizontal. Look, this is on the verge of breaking out. I've got this high a little bit above it. Is it going to go on another run like it did during 23? It could. But we could also find that it breaks higher and doesn't surpass that previous high and it starts forming a big messy range. Look, I don't know. I'd buy it again if it triggers a signal, but I wouldn't be expecting. We could, but I wouldn't be expecting a rerun of that previous big rally. If someone wanted to buy it here, it looks like it's ticking up as we're looking at it. Like, yeah, it is. It's ticking up now, and this is 20 minutes delayed as well. So I don't know where it actually is now. Maybe it's a touch higher. It could be bought at current levels, and you go, where would you put a stop? It could be just 10%, 11%, 10, 11% below, just below the 100-day moving average, below these lows from earlier in the month. So yeah, it's I think it's one to consider. But just go in like any other trade, no expectations about what it should do, because chances are it won't repeat what it did earlier. But you never know. So if you can, it's asymmetric in that it's 10%, roughly 10% downside potential, but the upside is always open. So yeah, certainly a stock to have a look at.
All right, RMD.
Trend's up, the trend is stretched. So it's above these previous high points. Look, if I had it, I'd continue holding it, see where it goes. But I find it a tough one to buy when it's like it's pulling away from the moving averages. Everything we've spoken about previously, but certainly one for me, I'd be hanging on to.
Okay. The next one is ING.
Yeah, I'd be if I had it, I'd be exiting. Like it did. It's been a bit of a messy one in that, like we did have that nice trend to it into earlier in the year, but then like it seems to be issues around when they announce their results, their financials. Like we had this gap lower in February, and now after the latest results, another gap lower. So it's one where you're kind of bracing come results, come reporting period. So we've now got 2 instances where it's gap lower the market, and both times the market was expecting had higher expectations. You can see it was hitting new highs. They announced the results, and the bottom falls out. So, and we did have this period where it was consolidating. Moving averages were declining, so it was vulnerable, but it looked like it was starting to get get a bit of a kick up again. If I didn't have this, I certainly wouldn't be looking at it. If I did have it, I would. I'd be looking to get out of it. The only question would be, do I want to give it a little bit of time and see whether it gets a bit of a rebound to the moving averages? So I might hold out to potentially sell it at a little bit of a better level. The risk always is when I do this, that it ticks lower and makes a new low, and then you've got to make the call of like, okay, what am I doing here? And often I'll just say, look, I've just got to now accept a larger loss because I played for the rebound. But I can't keep holding this one hoping it's going to recover. I've got to exit, and if it recovers in the months ahead, well, so be it. I can always get back in, but there's probably many other opportunities I'd be considering. But the risk for me is that it continues to decline or underperforms, so I'm out.
All right, fantastic. APX, please. Last couple now.
So this is an interesting. Oh, it's Appen, and this is an interesting one as well. I thought it was another stock. Look, this emerging uptrend is still in place. This is why. Like we could have, if we were looking at this a little bit earlier, I would have been saying, I probably did. We would have looked at this. I would have said, oh, look, it's a bit stretched above the moving averages now. So if I was in at a good level, yeah, hold it. But I'm probably not keen to buy it. And this is why, because stocks that get stretched, they do pull back. So this is how it's pulled back. Didn't quite get to the 50-day, but close to it. So if I've got this, I'm keeping it. It's like I'm probably not buying it here. I don't quite like the risk reward of buying it. I think we could see more of a range develop, just to settle down that this strong price movement from the July low. Like it's possible, like all sorts of things can develop, but it's possible we get sort of this sideways sort of motion. We talked about this earlier today. We get the sideways compression back into the moving averages, and then from there you get the breakout. That looks pretty messy the way it's all come up, but I think you see what I'm drawing in. I'd be inclined just to wait if I wasn't in this and see if we get more consolidation, and then take it from there. I'm just not so sure if I buy it here, where am I putting my stop? It's probably going to be like, to get below the 100-day moving average, 45%, that's too much. Using this little low from a few days ago makes it 23%. That's more palatable, but then if it forms part, this moves into a larger trading range, I'm going to get taken out of that. So I wouldn't be buying it here. I think it's a little bit trickier to manage the risk, but as I say, if I was already in, I'd be letting it run.
Okay. All right. And the last one for today, I believe, lucky last, is our old BHP, please.
Yeah, and I can say it's a no already because I looked at it this morning. I don't want to take on these declining moving averages. It's the momentum is very much to the downside. Yeah, look, it's the momentum's to the downside. It's like, how much further could it fall? Like we don't know. So I don't want to try and pick the low in these stocks. Like sometimes someone will come in and say, look, you just got to buy the dip in BHP. So what does that actually mean? I don't know. Like, people say these things, just buy the dip. But this is like a dip below declining moving averages. So yeah, it could base here. This could be the bottom, and it turns up, and someone will say, "Oh, I told you, you always buy the dip in BHP." But for me, the dips I want to buy are when the price is pulling back to rising moving averages. At the moment, we have declining moving averages, so the risk of further downside remains. It's going to take. I think it would take at least a couple of months, probably longer, before BHP could set up a situation where I'd be keen to buy. It's got a base. It's got to start rallying above the moving averages, and moving averages have to turn. That all takes time. So, yeah, BHP for me, I'd be. And I'm not going to say BHP is a sell, because some people have BHP in their portfolio and they've had it for 20 years. So that's a buy and hold strategy. It's a sort of stock which people will buy and hold, because it's the largest ASX stock, or a CBA taken over, but it's one of the two. It's one of the top stocks. So you can be pretty confident BHP is not like some of those mid-tier stocks, which could be down, which all sorts of things can happen to the downside. It's a large stock. It's a buy and hold staple of a lot of portfolios. So I'm not necessarily saying it's a sell, but it's not, for me, it's not a buy.
All right. I think that's a good lesson to leave us on here, Jason. That is, obviously, be wary or be careful of the dips that you buy, right? So the dips that you're going to buy. Thanks for today, Jason. It's been another quality show as usual. If we didn't get around to answering your question, or either one for Elizabeth, feel free to send it through to one of our, to support at Selfwealth, Elizabeth, if you want, .com.au, or send it to Jason. We can always answer it next week as well. Or
Elizabeth, just send me a note, and I can help you understand whatever it is that you're trying to get your head around.
Perfect. Exactly. All right, everyone. Thank you very much for joining us once again this week. We will be back next week, same time, same place. Thanks, Jace.
That's been fun, Rod. Great to have you back, and look forward to next week's show.
All right. Good on you, everyone. Have a good day. Bye-bye. See you.